Ok, puoi partire.
Okay. Then good afternoon or good morning, according to where you are, to everybody. And first of all, I wish to thank our speakers, Jan KREGEL, Elisabetta CERVONE, and Guillaume VALLET for having accepted our invitation to this workshop. And I'm also pleased because this is an interdisciplinary panel of speakers, because Elisabetta is a legal scholar, and Jan KREGEL and Guillaume are economists, but Guillaume also has also a sociological background. So I'm pleased that there can be a conversation and an exchange of ideas among different disciplines also. The title of the workshop is New Forms of Money and the Structure of the Financial System. There has been in the recently a proliferation of so-called new forms of money, and there are many discussions about the effect that the introduction of new forms of money will have on the structure of the financial system, whether the evolution of the financial system will be accelerated by technological innovation and by the introduction of these different forms of money. And what is the first question that I will ask the economist is about whether this type of money, which are very, very different from each other, for example, they can be crypto asset, or they can be telephone mobile services, or they can be Bitcoin or other form of crypto asset and so on, whether all these things or whether any of these things could be defined as money according to a post-Keynesian and Keynesian view. So we know that there has been in history a big discussion among many money theorists, but the main debate has been between those who think that money is a commodity, for example, like quantity theorists, and those that think that money is a debt credit relation expressed in a unit of account. We know, for example, that Keynes in the Treatise on Money stressed the role of money as a unit of account in which a list of prices can be expressed, as well as a way of discharging debts in a unit of account. So I'm just wondering whether such a definition of money as a debt-credit relationship, which is the Keynesian and often the post-Keynesian view, can be used to define these new forms of money. And in particular, I'm perplexed because I read that, for example, the ECB definition of crypto asset is a new type of asset recorded in digital form and enabled by the use of cryptography that does not represent a financial claim on or a liability of any identifiable entity. So if a crypto asset must not represent a financial claim or a liability of any identifiable entity, it's difficult that can be defined as money, as debt, and as a reciprocal relation of debt and credit between two entities. But in any case, I will leave the question open to our speakers. So I think it's better that we give the word to the economist first, So to Jan KREGEL and Guillaume VALLET, and then to Elisabetta, which will give us, which will speak about the regulatory questions related to the issue of this new money, in particular of crypto assets. So I give the word to Jan KREGEL now.
Okay, thank you, Domenica. The difficulty really that we have in dealing with this idea of crypto money, as you've suggested, is that we have two sets of internal disputes and discussions that are going on. On the one hand, we have the economists who are talking about the difference between the quantity theory and what I would call Keynes' liquidity theory of money, which is an academic discussion. The other is the discussion that goes on between I don't know how to define it exactly, the world of the internet and crypto. Because if you look at the world of internet and crypto, you have two very different ideas of exactly what are the implications of the creation of the internet. Now, I like to define this as referring to black holes. We know about black holes, and we know that we have theories of black holes. One theory says that the black holes destroy information. That is, anything that goes into the black hole, you can no longer recover. There's an alternative theory which says that the black holes, in fact, do just the opposite. And if you look at the current physicist reports, they have now identified that black holes, in fact, create new stars. And if you look at the internet universe, you have the same thing. That is, on the one hand, you have people who are arguing that the internet had an impact on information in that we could conceal information. We could conceal identity. We could conceal information about transactions. And this was the benefit of using the internet on the one hand, and also the benefit of providing this so-called alternative governance structure in terms of eliminating some sort of central controller of the system. Okay, so this is the one hand, and this is what is linked directly to the eventual creation of Bitcoin and others. On the other hand, we have the social media and we have the economic exchange. If you think of the mobile payment systems, PayPal and things like this, they were created in order to support the idea of person-to-person exchange, or what eventually became business-to-business exchange. And these were things in which you were supposed to be exposing information. That is, what was happening is that you were creating a market in which you knew everyone who wanted to buy and everybody who wanted to sell, and all you wanted was a means of facilitating this on the internet. So you have these two opposing ideas of just exactly what this cryptocurrency or crypto moneta is supposed to be doing. And the difficulty is that very often we confuse these two aspects. One is the academic discussion of just exactly what is money or what is the appropriate theory of money. And the other is the crypto discussion, is just exactly what is crypto supposed to be doing for us, okay? So this is what makes the discussion, as I say, so confusing and so difficult, because you have people who take alternative positions in both of these debates. And as a result of this, we are often talking at cross purposes, okay? Now, just to go back and take the idea, since we're trying to work from a post-Keynesian idea, I would start out by saying, if we really want to analyze these alternative digital means of financing exchange, we can very simply, and you've already referenced Keynes in the Treatise on Money, we can also go back to Einaudi. Einaudi explained to us very clearly how it was possible to have multiple coins, and those multiple coins did not in fact serve as money, The unit of account served as money, while those coins served as means of extinguishing debt. So this gives us a very clear system of, I would call, the post-Keynesian approach to money. It fits very nicely with the work of Minsky, who always argued in favor of what he called the first post-Keynesian theorem. And that theorem was that you should never dichotomize money and production. The real and the nominal cannot be separated, which means that basically, if you're thinking of the role of money, money arises in terms of the financing of production. This is why you have the debits and the credits that are so important. And this is why you have the unit of account. So this would be one way of saying, if I look at Bitcoin, and as you've already mentioned, you look beyond many of these cryptocurrencies, they are a claim, well, they're not a claim on anything. And if they're not a claim on anything, they really cannot be used to finance production. That is one of the difficulties, is that the critics of Bitcoin say that, well, the problem with Bitcoin is that we can't do the second level. That is, I can't do smart contracts which allow anything with Bitcoin. And if you look at the founder of Bitcoin, well, I still believe it's Craig Wright, but there's dispute about this. The founder of Bitcoin says, really, all I wanted to do was to make a means of payments on a small scale. That is, small scale payments, nickels and dimes. Okay? And one that provided a faithful ledger of transactions. Okay? Now, a faithful ledger of transactions has nothing to do with production. Okay? This is pure neoclassical exchange theory. All it says is that I provide a different, if you remember, Abba Lerner always argued that in neoclassical theory, peanuts were just as good as anything else in providing exchange. So that Bitcoin then becomes another kind of peanut. And if you want to use Bitcoin in order to exchange peanuts for peanuts, and this is basically all Bitcoin can do now, it can't finance production. So from the point of view of looking at a Keynesian system which relies on production for the generation of money, you would have to say, no, we have to classify it, we have to push these cryptocurrencies into the Menger neoclassical idea of money being only used to finance exchange. That is, you presume that everybody has endowments and everybody wants to use those endowments to exchange, and eventually, okay, something dominates. It could be peanuts, it could be Bitcoin, it could be anything. Now, the interesting point in all of this is that if you look at the cryptocurrencies, you discover that there is not just Bitcoin, there are multiple cryptocurrencies. And the question comes up, is it plausible to have competition, as Hayek suggested, across different currencies? And if you follow network theory tells you that by the same token, that if you want the telephone system to work, everybody has to use the same telephone system, otherwise it's useless, that eventually in the cryptocurrency space, if it is going to serve as that single unit that allows for exchange, there can only be one of them that becomes dominant. And the question then becomes instantly to the question of regulation and the question of how you allow the system to evolve. Do we really want, I don't know, Facebook to become the dominant currency in the financial system? And I personally don't actually use Facebook, but I know enough about Mr. Zuckerberg that I don't think that I would trust him as being the controller and the issuer eventually of the one cryptocurrency, which eventually, if it's going to succeed, is going to dominate. And this then instantly, as I say, brings up the role of regulation and the role of whether or not central banks should be involved in control of the system. Okay, I think I've said enough now. I don't want to take up too much time, and we can pass on to Guillaume. Fill in.
Okay, thank you very much. You were on time. So then I thank you for the intervention, and I give the word to Guillaume VALLET.
Yeah, thank you very much, Domenica and the Italian Post-Keynesian Network for this invitation. I am truly honored, and thank you very much, Jan, for this insightful presentation. It's difficult for me now to move on, and I am going to, as you say, the Domenica, to also rest on my sociological background to give my point, and I will include into the discussion the growing number of local currencies that we can see in the world. Of course, they don't have the same purpose than the cryptocurrencies in general, but sometimes they overlap, both overlap. So I'm going to also deal with the local currencies. And regarding local currencies, we can say that there are more than 5,000 local currencies circulating in the world. And there is a growing number of them, as I have said. At first sight, we could say that local currencies have their own sovereignty as money because they have an autonomous monetary space in which prices and sometimes debts are denominated in these currencies. And we could say that these local currencies are money regarding the means of the payment function from a neoclassical perspective, because this refer to their ability, the ability of these local currencies to foster trade, since, as Max Weber said, the most important fact of all about money is the possibility of monetary circulation. This is what I call the horizontal dimension of money. Indeed, the more money is used, the higher the incentives to others to use it. At stake is mimesis. Trade is created between users that would not otherwise have been in contact, and this corresponds to a monetary network associated with local currencies. However, I think we should go further, distinguishing between local currencies that merely rest on previous conversion from the national currency, from those which have their own system of credit. And to me, this is really important because the existence of a system of credit is crucial to characterize an asset as money. With this feature in mind, we can consider several crucial aspects of money. I mean, economic aspect of money, social aspect of money, and political aspect of money, which are very important in my view. Because money refers to a community and not only to an economic network. Money refers to a community in which payments have a higher status than reciprocal transfer, an economic and social chain whose links rely on successive but equilibrated claims and debt according to the choice of a special money and according to and which are related to a production. I totally agree with what Jan said before. And to elaborate on this idea, relationships of promise to pay, namely credit debit ties entailing reciprocal debts, are key because they enlarge the community. Trust here depends on the destruction and the regeneration of money through credit. For this reason, this is important to build on trust with institutions that hold money, namely banks, central bank, and the state. This is what I call the vertical dimension of money. Such a dimension refers to the collective desire to define a specific unit of account, which should be the first step within the community. This choice enables to decide collectively how to value things, how to value production, and thus, after that, how to trade. As the French sociologist Émile Durkheim said, it is easy to trade with people you know, but it's never easy to trade with people you don't know. So this is why this this collective choice of the unit of account is very important, because it's about shared values in a community, and this is very important. So in some local currencies which rest on such a system, to me, are monies, such as the Vir in Switzerland that have been studied for many years now. Um, I consider, having said that, I, however, consider that there is a kind of hierarchy between currencies in a given territory. To me, local currencies are not independent from the traditional monetary system, which includes the key role of the central bank. Central bank is supposed to have a structural advantage over local currencies, given that they offer the settlement currency that is, by definition, the safest in the economy. From my perspective, local currencies are likely to be accepted only if they are tied to a strong monetary national system. Monetary pluralism, in my view, monetary pluralism does not mean the end of monetary unity. These explanations I am giving on local currencies as money lead me to conclude saying that the monetary framework in a territory is complex, plural, and multi-layered. Monetary spaces are always served by multiple, complex, and overlapping circuits, and their members usually participate in more than one circuit. And against this backdrop, we can also explain the rise in digital currencies or cryptocurrencies. There are more than 16,000 digital currencies in the world, accounting for $2,000 billion of market capitalization. Like for local currencies, there is a great diversity of digital currencies with differing associated objectives. Some, such as Ripple, are dedicated to cross-border payments. Others, such as Dogecoin, are devoted to games. Others are called stable coins since they are backed by safe assets, public assets in general, such as treasuries, and because they seek to maintain a tight link to a national currency. The Libra, the digital currency and mentioned, which was initiated in 2018 by Facebook, was the first of a stable coin. And since then, three large stablecoin currencies have emerged on the market: Tether, Circle's USD coin, and Binance USD coin. So they have swelled to about more than $100 billion to about only $11 billion a year ago. So this is a huge rise in the use of these stable coins in the world. Other digital currencies have a dark side since they oppose the rules of the existing system. And maybe Elisabetta, we will deal with this regarding regulation, because some of them want to hide some transactions, want to promote even to promote fraud, such as Monero, Dash, or Zcash. And the most famous digital currency of that kind is undoubtedly Bitcoin, as Jan said. And finally, we can also find central bank digital currencies, and maybe in the second part of the discussion we will have time to talk about them, but they are issued by central banks themselves. According to data, around 80% of central banks are working on this issue in their own central bank. This is the case of China. This is the case of Sweden with the e-krona, for instance. And yes, some of them have already launched their own digital currency. So can we call them true money, in my view? I don't think so for most of them, because they are just crypto assets. For instance, Bitcoin is still rarely used as a unit of account, and it is not related to production, as Jan said. And even if we borrow from the neoclassical framework, Bitcoin is not a stable store of value because of its high volatility. So, and even its dangers. Likewise, most of them rest on the horizontal dimension of money, and I think the lack of link with a hierarchical dimension, I mean relations with the existing banking network or a central bank, could be a problem for the system. So I don't think these currencies are true money. They are just crypto assets, as I have said, because they have a lot of weaknesses, and they only promote economic relations and not social bonds underpinning money. And to me, this is yes, a very big weakness. So thank you very much, and I hope I haven't been too long as well.
Okay, thank you, Guillaume. And now we give the word to Elisabetta. We has to talk about, in legal terms, to tell us whether how are they considered in law, and particularly in the European Union jurisdiction. So this new forms of money, and particularly crypto assets. So stable coin, for example, which are Bitcoin is not considered almost as money, because for the reason we have heard many times. So, but now there is a focus on stable coins as a possible replacement of traditional money.
Right. Thanks, Domenica, for inviting me. Thanks for the panelists that are so exceptional and distinguished. So thank you so much. And I'm learning so much, I have to say. And so from the legal perspective, we all know that there are so many different regulatory approaches worldwide. We can think on one opposite, El Salvador, in which has recently passed a law which declare Bitcoin a legal tender. And on the other hand, we may think at China, which last year banned mining, while at the same time is still proceeding on her pilot on central bank digital currency since a year. And as far as I know, in US, there are various bills in since years that affect specific areas such as tax requirement or securities law. While I think that in August there was a proposal on quite a comprehensive bill on crypto regulation, even if not as comprehensive with the such as the proposal regulation on crypto asset that is discussed currently in Europe. So I would like to try to be brief on describing this proposal, so-called MiCA in Italy, regulation on crypto asset. This regulation, this proposal is 168 pages, so you may think how complex it is. And what is mainly, at least as I understood reading the text, the main purpose of this regulation is creating a level playing field. We have 27 member states, and the goal is mainly to create the same environment for crypto asset provider, so that if I will have as a crypto asset provider issuer a password, it will be registered, authorized in one state, I can provide my services in another state. What are crypto assets? So I will answer the I will try to answer the question on money or not money. Crypto assets are not defined as money in the regulation. Are defined, I'm reading the definition, as a digital representation of value or rights which may be transferred and stored electronically using technology such as DLT or similar technology. What is the scope of this regulation? As Domenica said, is mainly about stablecoin. So the regulation will cover 3 types of crypto assets, but two of them are related to stablecoin. I will focus on these two. One is well, it is called the e-money token, that are similar to e-money, as we all know, but they are backed by one single currency. And while asset-backed asset reference token, the other kind of stable coin, are referenced to several currencies. So in this, Libra has been mentioned before, the proposal by Facebook, now renamed Diem, but the project is still not didn't become real. So Libra was backed by several currencies, and then it was renamed Diem, backed by US dollar. Before going in some detail on the regulation, I listen about the fact that money, as for example, as a means of payment, they need a widespread use. Or the question is, should we have, as we are facing now, different means of payment? What happened? Because it seems that every system is on its own, so there is no interoperability between them. And on the other hand, if among them one will become the only one, bigger and bigger, we will have a competition problem. So here, regulation is really important, apart from other aspects, because regulation could insist on interoperability, and also control the market that could become bigger and bigger of some provider. And I had the experience of working for the G20 Italian presidency last year, and interoperability was one of the key issue in cross-border payment. So there was, but maybe we will talk later, a roadmap on cross-border payment. What are first of all, the regulation, the proposed regulation in the EU is not covering central bank digital currency, and so will not cover the pilot digital euro that we know is under discussion. The proposal is trying to make some, on one end, centralization of the crypto activities, on the other hand, supervision, on the other hand, also decentralization, because for main aspect, there would be the supervision by the European Banking Authority, by the ESMA, European Securities Market Authorities, the European Central Bank, of course. But on the other hand, there will be still supervisory power by national central bank. And this is also seen as also a key issue by the European Central Bank. So how to match these two-level supervision, and the ECB wrote an opinion on this aspect. Maybe also the proposal talk about coordination network, but it's also some kind of complex issue. Also, if we think that when we talk about cryptocurrency, crypto asset, we should think about network. So we have the issuer, we have the distributor. So there could be different entities that need to be authorized and regulated. what are other aspects? I try to make some note on the main aspect that could be of interest. And the regulation try to be risk-based. I mean, same regulation for same risk, and simplified requirement for less significant crypto asset provider. So there are some providers that are called significant based on the size of the market, on the investor, on the transaction, etc. And so at the moment, I will stop. I don't want to take more time, and then if you have other questions.
Okay, thank you very much, Elisabetta. So what comes out of this conversation is that the future will be full of we won't come back to middle age, but in any case, it seems that many things that the future of money will be very different from the present or from the recent past, in as much as many different forms of money will be available, and also regulation has to catch with this scenario. But now there will be a general discussion after the second round of questions. That's because some people have asked on the chat, but I didn't tell it at the beginning. But we have established that the general discussion will take place after the second round of the questions. So now I will ask again the speakers. And we have discussed about private new forms of money, so issued by private entities. And now I'm coming back instead to the perspective of a public digital money. A public digital money which should be issued according to many views by central banks. And there are also concern about the effect that the issue of this central bank digital money will have on the structure of the financial system. That is, that the issue of this central bank digital money could cause problem to commercial banks. It could deprive commercial bank of one of the main source of refinancing, which is our customers' deposit, as well as affect their profitability if they have to replace customer deposits with other sources of financing. There are also speculation about the use of this of new type of digital money for building an international payment system. And Jan KREGEL wrote a small paper in which he argued that an international payment system similar to a clearing union, proposed by Keynes, could build on the model of telephone company customers transfers, this web-tel, mobile, and so on. So I'm asking the speakers, so the economists first, and then Elisabetta, to talk about what they think about the perspective of the use of these new forms of money for a public currency or for an international payment system, a new international payment system. I will ask again Jan as the first speaker, then Guillaume.
Okay, thank you, Domenica. Here again, we get into a very complicated discussion between different points of view. Now, if we think of the first point, we talk about a central bank issuing its own currency. And what we should really think about, the first thing, is where did the central banks come from? Okay, let's just take the Bank of Italy. We know the history of the Bank of Italy. The Italian central bank came from a series of private banks, and those private banks were formed by the government through regulation in order to create a support for the private banking system. So if we think right away of this problem of saying, well, now we're going to have these central banks doing something else, that is, they're going to be something that previously was done by the private sector. Now it's going to be done by the public sector. We have to say that the entire framework that we're looking at, okay, is going to be very, very different. Now, across different countries, central banks have evolved in different ways. Now, I should say a caveat. This is aside from the fact that most Latin American central banks were formed by the US government imposing US type central banks on them. So we exclude the Latin American. But if we take most of the European and the American central banks, they have very peculiar history. In particular, the US had a system in which, number one, it did not have a common national unit of account. That is, the dollar came quite late. It was possible up until the 1800s and the beginning of the 1900s to go into the West and find, as Guillaume has talked about, local currency circulating quite happily. And the evolution of this system was one in which what we call the Wildcat banking system, that is, in which private bankers issued their own banknotes, and those banknotes circulated in local areas and also across the US. They circulated at a discount. That is, if you look today at Standard & Poor's or any credit rating agency, they started out by issuing the discounts on the various banknotes that were issued by the various private banks in the US. So you had sort of an equivalent of what we would have now. You can say all of these private banknotes are something like the multiple cryptocurrencies that exist. Now, how did these function? Well, the point was that these banks issued claims without having any backing to those claims. Okay? The story that would go on is that if a depositor would, or a holder of a note would come in and try to cash the note, he would discover that the office of the bank had moved. And this is why they were called Wildcat banks, because the office moved to the frontier where no one could ever find them. So the key to issuing banknotes was making sure that no one ever tried to cash the banknote into something real. Okay? Now, eventually what happened? Eventually the system collapsed, and the federal government came in and decided to create a central bank. And at this point, what did the government do? It created a national banknote. Okay? It said, instead of these private banknotes, the government is now going to take over the issuing of banknotes. Now, this worked reasonably well. This is 1914 until the crisis of the 1920s. And then what happened? Well, and then the system went into crisis again. Now, the response at that point would have been what? Well, if you had problems with the banknote issuers and you substituted a federal banknote, if now you had a problem with the issuers of bank deposits, because the federal banknotes, in fact, drove out of business the private bankers so that they now issued checkable deposits, what would have been the normal response? Well, if we're being totally consistent, the government took over the issue of banknotes, they should have taken over the issue of deposits. And we would have then had a central bank deposit currency, which is, or would have been, under the same technological conditions, what we are now talking about. Okay? So we're saying, first of all, this is not a completely strange idea, but it's one that we chose not to do. Clearly, we chose not to do when that alternative arose. So the first question we have to raise is that, are the central bankers and is the Congress willing to take the steps that they were not willing to take in the 1930s. Because in the 1930s, they stepped back and said, no, we're not going to have control. Okay. Second point is that if you look at the implications of deposit currency, it was quite clear in the 1930s that that meant that the private banks would have been out of business. Okay, as you've already mentioned, that they would no longer be able to generate earnings from interest differentials between taking deposits and lending. Now, the interesting thing is that the Federal Reserve has just issued a paper on central bank deposit currency. It raises this issue of whether or not the private banking system can exist, and in fact proposes a number of alternatives that stop before driving the private banks out of business. But if we think very clearly about this idea of the central bank now providing a deposit to the general public, the thing which they do not raise is that if you are the Treasury of the United States, why do you have to sell Treasury bonds to private banks in order to finance the government? The government could be financed directly through the central bank, through the issue of the central bank deposit currency or digital currency. Now, the implications of this are what? Well, I would argue that the implications of this is that you don't need the Federal Reserve any longer. Because if you don't have private banks who are issuing risky liabilities in order to finance the private sector and in order to finance the government, then the Treasury could do this all by itself. The implications of a central bank digital currency are that you could, in fact, abolish the central bank. And indeed, when the Fed was discussed in the 1914-15 period, one proposal was that it would be housed in the Treasury. Now, for those of you who are fans of modern monetary theory, you will notice that in modern monetary theory, there is this debate about the relationship between the central bank and the Treasury. This immediately eliminates that problem, and it says that quite easily, you could eliminate the Federal Reserve. You don't need it anymore. Now, having spoken enough about the US, I'll simply go very quickly now to Europe. In the European Union, or at least in the Euro area, paradoxically, you have just the opposite position. There is no Treasury to take over this function, so that in fact, what you end up doing is a central bank digital currency issued by the ECB would effectively become the Treasury function for the ECB. You would just get the opposite result. That is, you don't need the national treasuries anymore. You simply have the ECB that runs everything. Okay.
Yes, it will become the. Okay.
Yeah, go ahead. Okay, I think I've said enough on this slide. I mean, there are a whole number of other things that I would like to add about central bank digital currencies, but these are the things which stand out. That is, if you read this famous Fed report, it never raises the question of what is going to happen to the Fed if, in fact, this happens. And probably the biggest implication of this is that normally the financing of the government would now be done by direct issue of central bank digital currency. And you could simply
it's a fascinating idea. I thank you very much for it. We will discuss on it later when there will be the general discussion, because it's very interesting, your last point on Europe particularly. And I now will again the word to Guillaume.
Thank you very much. I think it is worth reminding us some characteristics regarding the evolution, the recent evolution of in the forms of money, to understand the rise in digital currencies and including central banks, the digital currencies, because we have been experiencing progressive dematerialization of monetary instruments for decades. Likewise, in many countries, there is a decline of the use of cash. And third, I think there is a growing interest from consumers for digital services, such as the growth of e-commerce, for instance. And against this backdrop, there is a growing demand for decentralization of payments, and technological innovations is the use of money at this decentralized level. And this is a challenge for central banks, to me, because central banks, which are centralized and which seek to centralize the payments, are facing a trend on with a kind of fractionation of payments because of the decentralized system underpinning many digital currencies. And this is why central banks, among other reasons, of course, have also decided to issue their own digital currency. And I can say that from an international perspective, digital currencies, including then central bank's digital currency, seem to offer for some persons, they seem to offer new opportunities. First, they could represent new sources of funding with a lower cost. This could connect more people to several monetary networks. This is the case for central bank digital currencies, of course, because being a riskless and fully liquid asset, central banks said that their digital currency could create an additional channel for deposit outflows, for instance. Likewise, these currencies would have the opportunity to improve the potential benefits of cross-border payments in the world. There could be also useful in countries under dollarization. Elisabetta mentioned the case of Salvador, and so for some political reasons, politicians in the country said to use another digital currency than dollar is a good way to promote sovereignty within the territory. And they could also promote the rise of the use of a kind of international currency through the issuance of currency separated from a dominant state. If digital currencies such as central banks digital currencies spread on an international basis, this could ease the move to a multipolar international monetary system, and maybe this is what China has in mind when with the e-renminbi, maybe. However, I would say that there are a lot of risks and maybe sometimes uncertainty associated with the rise of digital currencies in the world, especially, of course, with the currencies who oppose the system, because they often promise high or huge rewards in the context of globalized finance. And then they can create kind of casino capitalism, made of the potential fraud or in default risks, or this could increase speculation and volatility on some financial markets. In case of fast sales, there could be a fast drop of prices affecting all the actors on financial markets. And we could even think about a kind of a new bank run associated with cryptocurrency. And then repeat that an international use of digital currencies could increase the size and the velocity of international capital flows, rendering capital flows more volatile. There will be the risk of, to me, there could be the risk of several negative spillover.
There are some problems with the audio, I think. We can't hear you very well.
Can you hear me? No. No.
There's a problem with the with the audio connection. Well, it's we can't hear you anymore, and we don't see you. Can you hear me?
Yes, I can hear you. Can you hear me?
Yes, but very now only sometimes your voice and your image disappears very often. Now, for example, I can't see you and I can't hear you. I think the connection is disturbed. So now you just disappeared. Can hear? Well, I think that since Guillaume is no more able to speak, at least I think yes, I think we can give the word to Elisabetta.
Okay.
And so you can talk. You can tell us about the regulatory perspective linked either to the the central bank digital currency or to the creation of an international monetary system based on some sort of digital currency, however devised.
Yes, thank you. If Guillaume will be able to reach us, I will stop me and
yes, yes, so don't worry.
So he talked about the importance of cross-border central bank digital currency, international central bank digital currency. And I think that this aspect has also been understood. Maybe already.
And now you're okay, but no. You go on, Elisabetta.
Okay. And so it is at the cross-border level that is more interesting and more useful to investigate opportunities other than risk of and more risk also of central bank digital currency. So, hello.
Go on, because now.
Okay, I'll go on, and then if you. So.
Sorry,
the cross-border payment aspect of central bank digital currency has been investigated also by the G20 under last year Italian G20 presidency, and also will be under the current G20 presidency Indonesian, because it's part of the, I mentioned it very briefly before, the roadmap, G20 roadmap on cross-border payment, which encompass among the 5 pillars, if I remember, of the roadmap, new arrangements such as platform, which are entering the payment environment. And among them, in this area are global stablecoin and cross-border central bank digital currency. Why they seem to be very useful to address important friction in this aspect, because as we know, cross-border payment face high cost, low speed, limited access, and also lack of transparency. And the use of central bank money, we say, traveled by new technologies such as DLT, blockchain, could help on this aspect. Of course, being cross-border, risk will be even bigger. And this has been the reason why the roadmap included a lot of steps in studying and also driving some pilot on cross-border central bank digital currency. As for last year in July 2021, was endorsed a report made by the FSB in coordination with the CPMI, that is the Committee on Payment System. And they issued, they issue a report which had two aspects.
Yes.
Two aspects. One, take stock of the international dimension of central bank digital currency project and the extent to which they could be used for cross-border payment. And the second aspect, the report investigated the macro-financial implication associated with the cross-border payment. And also reading the report emerged that there are, as we know, no major institution that has launched a central bank digital currency, apart two minor live retail central bank digital currency, home that have a home dimension, so no international, of course. One is the Bahamas, and the other is called the $10. And the other is in the Eastern Caribbean. The name is Bcash. But there are so many, as mentioned, the advanced project. And many design and policy issues are still unresolved. And also, as I said, they focus on domestic issues, this project. And the report is exploratory, so discuss, examine several issues, and what is the roadmap aims will be for 2002 to issue design, study, and dissemination. A study that will be issued by the BIS in collaboration with the IMF and the World Bank. And also in 2002, there will be a study by the CPMI, IMF, and World Bank on the option for access and or interlinking. Interlinking is important. By interlinking, I mean interoperability. The report of last year on cross-border central bank digital currency identify three kind of model based on the minor, less, or more interoperability. The more interoperable model is based on one central bank digital currency based on multi-currency, but just one. The other two models are based on compatible system. The first one, less interoperable. So compatible, I mean central bank digital currency among different jurisdictions that share the same international standard. So they are not compulsory. They try to harmonize the system. And the second model, the medium one, is the one that is based on interlinked system. So what are the possible benefits that the report of last year identified on central bank digital currency are the fact that it may aim to address this friction, the legacy of the platform, existing platform, a limited operating hours, because every kind of model that I mentioned would have would be operating thanks to the digital means 24 hours, 7 days per week. And it would address truncated, fragmented data, and would address the fact that today we have long transaction chains with more intermediaries. Compliance, complex compliance check would be also addressed. Of course, there are risks, especially for the cross-border type of central bank digital currency. To briefly mention them, the potential increase of cross-border flows, potential financial stability risk, and currency substitution. That is a political also aspect to consider. And reserve currency substitution, configuration, and the backstop that arise from this. So I will stop on this, and as I said, I would like to mention the the central bank digital currency issued by the by Europe. Is so as said, the proposal regulation is not it's covering crypto asset, but not central bank digital currency. The pilot on the digital euro is launching. There is now we are in an investigating phase that began last July. Last July, and will last for 24 months. And so.
Okay, thank you very much, Elisabetta. Then, before opening the open discussion, I will give shortly the word to Jan, who asked to add something on the issue of cross-border payments. Jan, please.
Okay, I don't know, unless Guillaume had some additional points that he wanted to make in his comments before I start. Guillaume?
Yes, I can make them, but go ahead. I can do this after your intervention. No problem, Jan.
Okay.
Sorry, Guillaume, I just forgot.
No problem. That's my fault. I don't know why.
No, I mean, we have to, I think, not to be scared by these new technology things into losing our basic economic theory that explains how international systems function. First of all, let's simply think about fixed exchange rate and floating exchange rate systems. Okay? We have tried to impose both of them, and almost all countries have refused them. Why? Because under a fixed rate gold standard system, as Keynes pointed out, countries lost their domestic monetary sovereignty, and eventually they got rid of it. Floating rate systems with free international capital markets, which is what we would have under some type of internet transfer system, you have exactly the same result. That is, you have no control over your domestic monetary policy because international investment funds will be moving across countries according to different policies and distorting the exchange rate and thus their domestic production conditions. Now, all of this is a simple way to say is that when we talked about globalization 20 years ago, and this also now comes from my experience in the United Nations, everybody said, well, obviously we have a global economy, so we need a global money. How far did we get with the global money? Zero, because no government was willing to accept the global money because they lost their domestic monetary policy sovereignty. So we are never going to have any sort of international money. What are we going to have? And when Domenica previously mentioned that I had written something on the clearing union, and I think I'm surprised that people don't go directly to the clearing union when they try to understand the implications of this. is that the difficulty in Keynes' system in being accepted was, one, it had a common international unit of account, which people did not want to accept. That is, as we know, Germans love Deutschmarks and British people love the pound sterling, and they're very hesitant to give up their domestic currency because they believe it has a national essence. The other was Triffin's argument that it would be excessively inflationary because it could not be controlled. There was no central bank to control the creation of bank coins. Now, the interesting point that the new technology provides for the creation of a clearing union, and this is something which I tried to put out in the paper that you referenced, is that there were a number of other proposals in addition to Keynes' clearing union proposal. All of them were based on how the international foreign exchange market worked. If we think of the foreign exchange market, it works domestically. Okay? Foreign exchange never goes across borders. Foreign exchange stays at home. A bank domestically takes a claim on a foreigner and matches it with a creditor on a foreigner for its domestic clients. So the transactions are always in terms of domestic currency. Okay? Gold hardly ever moved across the ocean under the gold standard. And any imbalances that you would have, I mean, if you have a balanced trade position, then your credits on foreigners and the claims on foreigners match. Okay? And you simply have what everybody knows bankers do is to match in terms of domestic currency. Okay? Now, if you look at the Schumacher proposal, which was one that was forwarded at the same time as Keynes did his, Schumacher's proposal said, why don't we set up this kind of system so that all of the matching in claims and credits is done by a domestic or a national system. And these national systems then engage in a meta clearing amongst themselves. And there is no international currency at all. Now, if you look at this, this is a stroke of genius, because he said the thing which is stopping the imposition of some sort of international coordination is the fact that individual countries all want to keep control. Well, if they keep control of their domestic national foreign exchange board, I can't remember now exactly the name that he gave to it, then they had control if it turned out that a domestic importer, okay, had excessive expenditures that were not matched by claims by exporters. The national monetary authority could intervene to impose the balance so that everything stayed at the national level. It was not necessary to give up sovereignty to some sort of international agency or an international money or something that you couldn't control. Okay, so the basic point which I was trying to make in this paper is that, oddly enough, by chance, I discovered this payment system based on a mobile telephone system. Now, the mobile telephone system is basically irrelevant in this context. The context was that all of the exchanges within this system take place bilaterally and they take place nationally. There is no international currency that is imposed on this system. And it more or less replicates Schumacher's proposal. So that I get, as I say, I get a little bit nervous with everybody talking about this interoperability and cross-border payments and everything else. The solution to this is to not do cross-border payments, because cross-border payments people do not like if you sit in Congress and if you sit in a central bank. Because cross-border payments, freedom for cross-border payments means you lose control over your domestic monetary policy.
Okay, thank you very much. That's a very challenging discussion. And now we should give, Guillaume, do you have any remarks?
Yes, I just wanted to add, but very briefly, what I wanted to say before my network collapsed. Yes, I think the rise in digital currencies is challenging for central banks regarding their monetary policy I mentioned the new linkages between the remuneration of on digital currencies, the level of interest rates and exchange rate, and this, to me, this could accelerate phenomena such as carry trade activities. So it's challenging for central banks. And the second point I wanted to say about central banks is that what's going to happen if large companies being dominant in the system with their own currencies, what's going to happen regarding the security of the network, technological network. This is a big issue, I think, for central banks, especially regarding their inner organization. I am working on the impact of the COVID crisis on remote work, including central banks, and central banks have to secure their network because they work, they are supposed to work 24/7. And with the rise of these new actors, there could be a problem of security regarding the networks. And because
I'm sorry, but I have to stop you because it's very late, and otherwise we won't have any discussion. You
but can
contribute to the general discussion if you like.
Yeah, of course.
Otherwise, the discussion will disappear, and it would be a pity for all the people who listened. You understand? Thank you very much.
Yeah, of course. Sorry. Of course.
So now we can open the general discussion. Please, there were already some questions from Facebook, I think. I'm just. Yes, I read one question by Sergio Cesarato, which was the very first one. One of the main purposes of regulation is to forbid lending activities by stablecoin issuers. Is that so? I don't know. Maybe Elisabetta or anyone who wants to answer?
I would say that is one of the objectives, an important one. It's not the only one, or I would say the main one, but of course is really important. And also, for example, the fact that it prohibits for the investor to receive interest in their asset token. So this will limit the activity of crypto asset provider, and would emphasize the role of so-called stablecoin more as a means of payment that as an investment. But of course, it's really important that aspect.
Okay. Thank you, Sergio. If you're still here, do you want to answer, or do you have any other question on the issue? Well, okay, I guess not. But
Domenica, could I come in on this one?
Yes, of course.
Okay. I don't know. The problem is that if you look, 2 of the 3 stable coins that we've mentioned are currently under investigation by for criminal activity. Criminal activity because they in fact do not have investments in the assets which they suggest that they have. So this is the first difficulty. The Attorney General of the state of New York has already taken Tether to court for a cease and desist order. Now the difficulty is that these things can operate internationally, so Tether can function outside of the state of New York, outside of the United States. But the investigations that were undertaken of the investment portfolio showed that, in fact, there were virtually no US dollars at all held in the Tether account. And most of the investments were investments that were somehow or other linked to the US dollar, and the majority of them were, in fact, commercial papers that were issued by an arm's length institution that was run by Tether. So, number one, when we talk about stable coins, these stable coins are not stable at all. Okay, if you look, President Rosengren of the Boston Federal Reserve Bank very early identified the fact that stable coins were the equivalent of what in the US we called money market mutual funds. Money market mutual funds were a major cause of the collapse in 2008 and are now subject to very, very strong regulation. And eventually, stable coins, if they exist, would be subject to those same kinds of regulation. So that Cesarato is exactly right. Eventually, regulation will prevent the stable coins from, in fact, using lending activities. Now, the point is that I think Elisabetta had mentioned is that stable coins really exist not in order for people to execute payments, but in order for exchanges to be created in which stable coins become the unit of account across the various other cryptocurrencies. And in fact, in terms of the issue of tokens. So that this is what creates the possibility of paying people for what are called these liquidity pools. And you yourself have already said that these cryptocurrencies have no reference to any value. So you have to ask yourself the question, if they don't have any value, how can they generate income? Where does that income come from? And that income comes simply by the fact that the stable coins manage to attract initial investors in the stable coin. So that these are a pure Minskian Ponzi scheme.
So Ponzi scheme. And so you see that what's interesting is that you see that this the stable coin becomes the unit of account for other stable coins, or yes, I understand. Thank you very much for this point. Now I have to read the question which comes from Massimo Cingolani. It's a question to Jan. One of the aspects of Keynes' clearing union was to put debtor and creditor countries on the same level in terms of obligation to reduce imbalances. How is this realized in Schumacher's proposal that you mentioned? Because it seems to me it would, moment please. Oh, I'm not able to, it would,
it would be left to bilateral bargaining. I mean, it would be left to the power of each country to bargain with others. I mean, is there any rule for that?
Okay,
as you know, Massimo, there was a problem in the clearing union proposal because, in fact, you penalized countries who managed to engage in successful export-led development strategies and vice versa. And this has always been one of the, I think, my main criticism of the clearing union proposal. For example, if you're China and you're trying to develop the economy on the basis of export-led expansion, then if you're in the clearing union and you develop a surplus, a bilateral surplus, which is too large with the US, there was a penalty. Now, what Schumacher does is to create the system by which the net claims are not bilateral, they're general, okay? And what he points out, and I encourage you to go and read the paper because it is available. It's one of the amazing things is that this has been more or less completely forgotten in the current discussion, and indeed was very little discussed. But Schumacher was interested in multilateralism. And what he pointed out was that if you were the alternative, you were the surplus country side would have a surplus not in terms of the alternative currency, but in terms of the general pool of other currencies. And he pointed out that this would create an incentive for surplus countries to, in fact, use their surpluses, which was quite different from simply a penalty being imposed on that country. Now, this is not to say that the problem doesn't exist, but it does have in it an economic mechanism rather than a regulatory or a penal mechanism in order to bring about increased stability. As Schumacher continued to say, we really do not care about bilateral imbalances. What we do care about are multilateral imbalances. And again, going back to the case of China, we know that the difficulties that China faces are because of the bilateral imbalance with the US, whereas China has now a negative balance with the rest of its trading partners in Southeast Asia.
Thank you. I will try to look for the paper.
Okay, thank you. Is there anyone? Are there any other questions? If there are no other questions, I will ask one. Because I was very interested in your comparison between the US and Europe as to the eventual issue of a central bank digital currency. And your last sentence, as far as I can remember, was that if the European Central Bank would introduce this central bank digital currency, then it would become the treasury in a way.
Okay, this obviously I was trying to be provocative here in
yes, but it's very. I think it's very interesting, this idea, because I was thinking of something like a bit different. That since in Europe there is an incomplete banking union. There is a common supervision of banks. But there is no common insurance scheme for deposits. So each country has its own insurance scheme for deposits. And as you know, if there is no central bank that can provide financing to insurance scheme for deposit, actually they are moot. I mean, they don't work if a big bank fails and so on. So actually, since there is no common scheme of deposit insurance, I think at the European level, deposit insurance, even for the threshold which is insured, is doubtful. So I think in Europe, the possibility for a citizen of a country, of some countries, to have a deposit at the central bank would be very appealing because of this particular feature. And the deposit central bank would become the only very safe asset, because there is no treasury, which is common, and there is no deposit insurance, which is common, even for the insurance deposit. So it would be, in Europe, it would have a particular appeal. I don't know whether you share this thought.
Yeah, no, this is again the impact of this parallelism, well, reverse parallelism, if you like, the specule problem between the U.S. and Europe, because in the U.S. Minsky had always argued that the deposit insurance supposedly was paid for by a fund, but that fund was backed by the U.S. Treasury. So that implicitly the deposit insurance was always with the central bank. That is, because it was implausible to believe that in a major crisis, the fund would be able to defend the claims of all depositors. So that it was the Treasury that actually was the responsible party. Now, the question is, how would that function? Well, under the system as it currently does, the Treasury would then have to emit Treasury bills. The Treasury bills would have to be purchased by the banks. The banks would then have to create new deposits, which would then be exchanged for the deposits which had defaulted from the banking system. So obviously, it would be much simpler if the Treasury had issued those deposits itself. So if you now transfer this to the European system, we know that in the European system, there is no general fund. And in fact, different countries, some of them have public, some of them have private deposit guarantee funds. The simple answer to this would be, well, let's have the Treasury take over this function as in the US. But there is no Treasury. There is no federal Treasury in Europe. So obviously, you can't have the Treasury do it. So who ends up doing it? Obviously, the central bank now becomes the guarantor of its own deposits. And you're quite right. That's how you solve the problem. Now, the difficulty here is what? The difficulty is that if you remember back to the discussions of the Maastricht Treaty and the development of the euro, the Germans had always argued that this was impossible. This was impossible. Why? Because this meant the central bank would lose control over the money supply. Because as soon as the central bank, as soon as the private bank goes bankrupt, the central bank would have to step in and expand the money supply in order to cover the losses. So the Germans are the ones who, in fact, argued very strongly against having even a federal or a European-wide deposit guarantee system. But if you go to the idea of having the central bank digital currency, eventually this is where you're going to end up. And this is, again, one of the reasons that I would argue that it's going to be very difficult for the
So you think it will be very difficult to get Germans' approvals for a project of a central bank digital currency?
Yeah.
Yeah, I think, thank you very much for your interesting contribution. Is anyone willing to ask a question to any of the speakers, or even the speaker to each other? What, for example, Elisabetta, you follow with this G20 works on central bank digital currency? There were divergences of opinion between different countries' representatives.
I didn't follow so close the development of the report because I was dedicated to another pillar of the G20 agenda that was on financial inclusion. That was really, really interesting. And also central bank digital currency, one of the objectives they say is also financial inclusion. But well, I have to say that on that aspect, most of the decision has been taken by the FSB, like the Financial Stability Board. So, but I cannot tell you about particular position. No.
Okay, thank you in any case. Thank you very much. And then I repeat, is anyone else willing to ask questions? Okay, and then I have another question because nobody makes it, just a final question. At the beginning, you spoke about ways to you spoke about the now the idea of imaginary money. So that there can be a unit of account and many tokens that are denominated, that are issued. They are different from each other, but issued in the same unit of account. So you think this could be the future of our?
Well, it's difficult to think about what the future of this would be, because the evolution of cryptocurrencies has gone far beyond anything that I could ever have imagined in the beginning. Now, the point is that, yes, we do have this difficulty of the multiple issues. And it's interesting, if you look at the financial structure inside the crypto universe, okay, it seems to be perfectly replicating what we've already seen in private sector finance. As I say, the stable coins are in fact not there because of the stability of the coin. They're there in order to create the exchanges in which it's possible for individuals to change all of these multiple currencies back and forth. So this is part of this idea of liquidity. Where does the liquidity come from? Okay, because if you don't have the exchange, and I don't know, you've got a Dogecoin and you want to, well, as I mentioned, we now have this famous FJB coin, which Steve Bannon is issuing for the insurrectionists in the United States. Obviously, you can't trade them back and forth, one to the other. So somebody has to intervene in order to take both sides of the contract. They have to be willing to be buyers and willing to be sellers. Okay. Now, we know that in dealer markets require capital. Okay. If I'm quoting a bid price and an ask price, it says that I'm willing to buy at this price and I'm willing to sell at this price. Okay. So it means I have to have an inventory. I have to have some of the thing which I'm providing the market in. And this requires capital. So the question is, where does the capital come from? And the capital usually in these exchanges comes from the issue of the tokens for the exchange, which people are willing to take in exchange for their other currencies or directly for what they call official currency, which is fiat currency. So that they manage to self-finance themselves. And then, in addition to that, in order to attract more business, they set up the liquidity pool. Now, the liquidity pool is what? The liquidity pool is simply a way of enticing people to hold your tokens in exchange for, well, in exchange for what they call income. Okay, and if you read the blogs, the crypto blogs, you find people, saying, well, I have found a mechanism by which I don't have to do anything. I simply go into my liquidity pool, I pledge my assets, and I earn income, which is enough to allow me to retire in 10 years. Okay? And we know this can't be true. We know it can't be true because there is no income being generated. Anything that gets paid out is created inside the system. Okay? So that this is just like the Wildcat bank. As long as everybody stays in the system, the values remain stable. If people start to leave the system, they try to cash out, then the system collapses. And I won't say that this is what's happening, but if you've been watching the prices of Bitcoin since it hit its maximum, okay, on a 1-year basis, an investor in Bitcoin is now currently earning a capital gain of something around 8%, okay, which is not something, given today's inflationary framework, which is very satisfactory. Remember, the argument was that, okay, Bitcoin is unstable, but at least it covers us against inflation. Well, it doesn't do that anymore. So all of these new mechanisms you see coming in, these new liquidity mechanisms, are ways to attract people to come into the system, because the system can only live as long as it continues to expand. When it stops expanding, then the opposite happens and the system eventually will crash. So this is the difficulty that we have in terms of these stable coins. And it's, it's sort of interesting that people actually think that the stable coin can in fact be anything other than a mechanism for attracting additional investment in these exchanges.
So regulation is urgently needed.
Well, the difficulty is, if you look at the figures, okay, now I can't, off the top of my head, I cannot reproduce them, so I'm going to have to invent a little bit. Something like 25 to 30% of the funds that are going into stable coins are borrowed against credit card accounts in the official banking system. Okay? We also know that less than 10% of the investments in the stable coins are in fact invested in straight US dollar assets. So that on the one hand, you've got something like a third, and the other hand, you have something like 10%. And this is a relatively high leverage. If it turns out that the stable coin collapses, okay, what happens to all of these loans that individuals have taken out against their credit cards? Okay, they default. And this is why suddenly you'll notice that central banks have started to pay attention to stable coins, because a large proportion of the investments of the private sector in those stable coins is being funded by borrowing in the regulated banking sector. So that when this starts to unravel, that is, were there to be a 30 or 40% decline in the price of Tether relative to the dollar, which, if you remember, for a while we thought that most of Tether's investments were commercial paper in Evergrande, the Chinese real estate investment fund, which is technically bankrupt. So that if that were indeed the case, the assets behind Tether would be technically bankrupt relative to the size of their investments, which would mean that there would be a very direct impact on the regulated financial system. And this is why you've now discovered that if you look at the latest regulatory items from the US, it has become quite clear that the SEC has decided that these are not money, that they are assets, that stable coins, yes, in fact, may be considered as money, and it's the responsibility of the Federal Reserve to regulate the stable coins. So that everything else is now assets subject to SEC, and the stable coins are subject to Fed regulation. And this is because the Fed is now extremely worried because a large proportion of the banks that they regulate, in fact, do have direct exposure to crypto through the stable coin.
Sorry, I just my microphone was off because there were the clocks of Santa Croce disturbing. And but I thank you for your interesting observation. Is anyone else willing to ask? I think there was a question from the yes, the Italian Post-Keynesian Network. A question from audience on Facebook: could central bank digital currency help in democratizing credit and use it to direct financing of well, I don't read, but with some beneficial outcome? Sorry, I have some problem. And use it to direct finance for more socially beneficial outcomes like fighting climate change. At the moment, we seem to rely on asset managers' own frameworks through ESG. So could central bank digital currency help in democratizing credit and use it to direct finance for more socially beneficial outcome like fighting climate change? This is the question.
Okay, I mean, I can answer that if you like. I mean, the question is in the democratizing. Okay, as you know, crypto is supposed to democratize by doing what? By distributing the decisions, okay, across all members of the holders of the crypto asset. Okay, now there's nothing that guarantees that all of these holders of the crypto assets are going to make proposals to the runners of these coins to say that we should only back ESG investment in terms of the creation of these coins, okay? And this would be absolutely against the very essence of this idea of a distributed governance system. The distributed governance system means that there is nobody who decides. On the other hand, democratizing credit, if the central bank decides that it's going to fund, for example, in the US, we have this proposal, the Build Back Better proposal, which we can't get Congress to approve. If the central bank would to say, we will create central bank currency in order to fund all of the environmental measures in that bill, then we wouldn't have to worry about Congress approving it or not. But again, how democratic is this? This would be democratic in the sense of the central bank deciding to pursue one particular set of proposals, which we can't get the democratically elected legislatures to approve. So the difficulty I find here is that in this idea of somehow or other democratizing credit, okay? When the cryptocurrency issues talk about democratizing, okay, this is distribution of responsibility in which there is no central agency that makes those decisions. And if that's the case, you have no guarantee that the results are going to be the ones that, well, implicitly, the question, I presume, says that democratic decision would be to fund ESG. So that's the difficulty that you have. Simply creating a distributed governance or a distributed ledger type of governance system doesn't guarantee the kinds of results that you get. If you take, for example, in the US, we have a system which supposedly requires banks to fund investments in their own communities. Okay? Now, if you think about this, it doesn't make any sense. It doesn't make any sense why. Well, we know that banks don't take deposits from the local community and then invest them outside of the local community. We know that banks create deposits in order to purchase loans. Okay, this is the famous loans create deposit system, right? So there's nothing that's being taken from the local community. The problem is not that the banks are taking resources from the local community without giving it back. It's that the banks aren't deciding to invest in the local communities because they don't think it is sufficiently profitable. So if you want the banks to do this, either you have to give them an incentive to do it, that is either grant subsidies or give some sort of support, or you can try to increase incomes of domestic residents in these communities so that the banks consider them to be good credit risk. Okay. Now, again, is this democratizing or not? Okay. Difficult to decide. Now, if we want financing at the local level, we know that there are ways to do it. Guillaume has mentioned a number of local currency systems, which in fact do create local financing. But they don't create local financing by conserving domestic savings in the local area. They do it by creating credit in the local area. The credit creation problem that is the one, not the intermediation problem. So, I mean, I always get a little bit nervous with this idea when people are using this idea of democratizing. Because as I mentioned, inside the crypto community, you have these two very different ideas of what the democratic system is supposed to be doing. Okay, if I'm a first round crypto Bitcoin investor, I invest in Bitcoin basically because nobody can tell me what to do. Nobody can take the money away from me. Nobody knows what I do with the money, and I am completely isolated from the rest of the world.
Well, but not even, no, this is a joke that I read the report by Italian police. They just listened to the conversation of mafia dealers with Colombian drug dealers. And the mafia men, they proposed to pay in Bitcoin, and the Colombian drug dealers rejected the offer. They didn't trust Bitcoin.
Well, that's because, again, these systems are not completely isolated. Okay, as long as you've got 10 or 15 miners, okay, who are doing the blockchain verification, okay, there's information there that somebody can find. I mean, this is the difficulty with it, is that the part that's public in the crypto system is the blockchain. Okay, anybody can see the blockchain. So obviously, if you're the Colombian dealer and somebody says that, you know, we're transferring X million, whatever it is, it's a relatively simple matter to go through the blockchain and to identify, okay, okay. So they are in fact not completely anonymous.
Okay, thank you. So if there are no other questions, I think I will thank all the speakers and all the participants and close the webinar here. Is there anyone willing to talk?
I just would like to add some things regarding the question raised in the chat, because I think environment is a very important issue. On the one hand, CBDC could, for the people who are in favor of this, CBDC could help fostering new kinds of credit trying to gather central banks directly with the public, and this is what economists from central banks have in mind. And this could change the channel of credit when big banks have a market power, for instance. But on the other hand, I totally agree with what Jan said, because the word democratize is very important to think about. Central bankers are unelected technocrats, and they're independent. So what are they going to decide regarding the legitimacy of their choice? And finally, issuing a CBDC has also an environmental cost. So we have to compare what would be the benefits from environment to create a CBDC and the cost for environment of issuing these monies.
Why doesn't it? Sorry, why do you think it has an environment cost issuing a central bank digital currency? I mean, it's the same as
yeah, because you are going
transfer of money, I think, on a computer.
Yeah, but you are going to use energy, and you have to, I think, to compare both of this, and this is also the environmental cost of all the digital currencies should be more studied, in my view.
Yes, but I think everyone thinks of Bitcoin as being as consuming a very big amount of energy. But if you just make a money transfer on the internet, well, I'm not an expert, but I don't think it's so energy consuming. But maybe I'm wrong.
No, you're right on this point. Is that the central bank digital currencies would eliminate the need for all of these miners doing the verification on the blockchain, which the central bank would presumably subsume. And certainly the central bank would not have to do the mining in order to do this. And if you think of it, I don't know, a very simple proposal. Most banknotes have serial numbers. Digital central bank currency could simply be, and there is an early proposal by Chaum on eCash, which unfortunately didn't work, which was much better than Bitcoin. You could simply use those the serial numbers that you use on the banknote, okay, to create a digital currency, so that the public would have the choice of taking either the physical piece of paper with the serial number on it, or getting a deposit at the central bank, which was identified by a serial number, which was previously assigned to the physical banknote. And then all that would have to happen is the central bank would have to get rid of the paper note that is represented by the computer entry for the serial number.
Okay, but thank you.
That's too easy for people. So nobody.
Yes, it must be complicated, otherwise it does not attract enough attention. Okay, then I thank you everybody again for this interesting conversation, and I thank you also the people who were listening and who asked question or didn't ask a question as well. So I hope to see you again in other avenues to discuss monetary matters again. And so I think thank you to everybody again, and I think that we can consider this meeting closed. So I say goodbye and many thanks to the speakers and to the listener.
Okay. Thank you.
Bye-bye.
Thank you. Thank you.
Thank you.